Hello, fellow traders. 'Tis I, the Rumpled One, coming to you again with another Trading with Squigglies video. Moving averages. Probably the most used squigglies are the moving averages. So let's go ahead and take a look here. I have set up using my tunnel indicator back from the I think it was from the turtles. They had some kind of tunnels, or this was for something else, but what we have are three moving averages. We have the 20, the 50, and the 200. And usually when you read trading magazines or see trading articles in the mainstream media, those are the moving averages they use, the 200, the 20, and the 50. How do they use them? Well, they use them to discuss trend. So, for example, with the green indicator, or the green moving average, let's just go over. Green is the 200, the orange is the 50, and the red is the 20. So you'll be with me here. In fact, let me turn off one other indicator while I'm at it, just to clear up the screen a bit. Okay. So above the 200, they consider this an indication that the market's going up, and below it, it's going down. Okay, and just to be fair, usually they have it on the daily chart. So you can see here's the 200. So it's above it, so you'd be looking to go long. But as you can see here, price was coming down. But they're saying that the long-term trend is up, and it had been making newer highs. But you can see, and then down here we've got a switch. It's low and it made a higher low, reversed, slightly higher high, and reversed off of there. So you can see it's kind of hard to gauge using that 200 moving average, because you could say, well, let's buy the dips. Well, okay, we could buy that dip here, but then right here we could buy that dip, and it got us in trouble. So what they then use is they say, well, we'll use the 20, the red, and the 50, the orange, and we'll just trade when they cross over. Well, you can see here, you were waiting a long time. Okay, yes, right there, you would have made some pips, but there was a long wait, and then here it crossed down, and you would have made some pips. So you can see you can use it, but it's really kind of iffy. So I guess what you're saying is, okay, it's above the line, the 200, we've got this crossover, now it's safe to trade. Okay, here it's below the line, we've got the crossover, and now it's safe to trade. So it doesn't look bad, but there's a lot of waiting for that signal to happen. And that's okay, because waiting, that's what you do in trading anyway. So that is one way to use it. But you can see here, you miss a lot. And so what if you just looked at used the moving average, and you used it for looking at price action? You say, okay, this one's going up. Well, the longer the moving average, the slower it's going to react. So maybe you use something like the 20, but actually there is a better moving average to use. So let's turn off these three, and let's turn on the MA in color that I modified. Let's turn this one on, and what we're going to use is we're going to use an EMA 5 period using the close. Now, as you can see here, this moving average is pretty much within the candles. You see that? That's the first thing to know, whereas the other ones, the candles were usually above it or below it, but this one's in it. So right here you can see with some price action, you've got a low, it's crossing above, it's closing above. Now this is where you can start your entry. Okay, even here, it's below, got some price action. If you take this trade, you might want to sit there and watch it, but then you can see here, then right here, you can see it's below. It crossed it, crossed below. There's a chance. Now, sometimes you can see right here where it gets a little dicey. You crossed above, you took that, you got some, but then it crossed below. Maybe you took that and it's little. You see here, this is where you get what people would call the chop. Well, what you want to look for, once again, is to go back and see what price is telling you. Lower highs, lower lows. Finally, you get that big lower low. You get the 3 ball. Okay, and you see it came up, it crossed below here. So maybe right here, there was a chance where you might want to take that exit because it closed. See, it crossed below, so you out, comes back across. And right here, based on price action, that's probably where you wanted to get long when it broke that high. If you wanted to continue trading this. So once again, reading the chart here, your high, okay, you get a red candle, it breaks that low. It's time to take some money off the table. You could even wait for the day to close, and right there it's telling you, yeah, you could take some money off the table. Or if you got in the trade and it was up, 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 and then it's, see right there, you got a high, lower high, lower high, it starts to come back down. You could have maybe taken that price action exit right there. Because people always want to know, you know, where do you take, or when do you take money off the table? Well, it's when the price action tells you to. Now, as far as stops, well, if you're late to the game, I don't know what to tell you, but see right here, if you take this trade, where would you want to stop? You'd want to put your stop below here. So you take your position size and size it accordingly. So this would be your trigger right there, and you give it that much room. And that's almost, let's see, low is 31. And the trigger is 48. See, that's 117 pips. So you might put on a very tiny position there to give it that wiggle room. Or you might even say, well, maybe if it breaks through the midpoint of the candle, you could cut that in half. You could see it got close but didn't quite hit the midpoint. And then you can continue. But you choose how to make your stop. But it should make sense. If you're going to choose where to place your stop first, it would either be below the low or right below the midpoint. Okay, because if it retraces more than 50%, chances are it's going to keep going. And you don't want to be in the trade and find out the hard way. You'd rather stand off to the side, because if you stop here, let it go down, you can always pick it, get back in the trade at where you stopped out when price is telling you, hey, I'm coming back. That's simple. You see, that's the things they don't really tell you in some of those other places. So if we widen this out, you can see right here, you've got a red, green, right there. If you took that trigger, and then it came back down, you probably want to stop out right about there. Because see, it went up, it's already breaking through the high. Now if it's coming back into the body of this green candle, then the sellers are just pushing down. Because you see, you did have the price action. You had lower low, higher low, broke the high. So right there, that's one place where you could have entered. Or if you waited till the next day, you would have entered there. So entering right here, you're way in profit. Entering here, you're basically going to scratch the trade or take a small hit. Because you see here the color of the MA, the MA is still decreasing. But you can see here the MA is increasing. Okay, so red followed by green. Right there, if you take that as your trigger, you see what happens next. So that's how to use moving averages. I set it up in the dashboard over here. So if you just want to see how to do that in case you like moving averages, right there, you're using the internal moving average. And as you can see, there's lots of squigglies that you can use here, all those internals, if you want to use squiggly lines. But that's how to use it. And the EMA 5, I remember reading an article decades ago. It was in a trading magazine, and I don't recall what the magazine was, but they said they ran all the statistical analysis and they came up with the EMA 5 as being the best moving average for trading. So I used it for a while. In fact, if you guys remember back in my TradeStation days and eSignal days and even in MT4, I wrote something I called Indicator 2, which was an indicator based on the EMA 5 and whether or not closed above it or below it. So if it closed above it, it was aqua. If it closed below it, it was magenta. And there was a couple colors when it was like closing above, but I think it was crossing above and then closing above. So it's been a while. I don't remember what and the other two colors very rarely appeared. The yellow just indicates a change in direction. So you can see here, it went from going down to going up, went from going up to going down. So it just gives you a clear indication which way that squiggly is pointing. And I put the price boxes here so you can see the value of the indicator. And you can compare it to close. And in fact, that particular indicator, this one, has a gauge. We can turn it on, but let's move it out of the way of. And once again, a little upside down triangle is the chart shift. You pull it over and then you can have some room. And so you can see here I actually need a little bit more room for this gauge. Bring it over here. And you can see this shows you the value of the moving average and how many pips close is above or below it. So right now the closing price is 24 pips below the moving average. So that's it, fellow traders. That's how to use the moving average squiggly line indicator. I don't think I harmed it, so no squigglies were really harmed in the making of this video. Anyway, I hope that helps. And as always, fellow traders, it's not what you trade, it's how you trade it. TheRumpledOne signing off to drain the banks.